Welcome to the News Hour. The Federal Reserve cut interest rates today for the first time in 4 years with an aggressive move that lowers its benchmark rate by a half percentage point. The Fed also said it intended to lower interest rates by a full point before the year is out. Fed Chair Jerome Powell said now is a good moment to make cuts and boost the jobs market.
The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
For more on what's behind this decision and what it could mean, I'm joined by David Wessel, director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. David, good to see you.
Good to see you.
So this decision to cut interest rates by a half percentage point, not a quarter point, as some had speculated. What's behind that and why now?
I think the Federal Reserve realized that the labor market is softening, or the metaphor that Jay Powell used today is cooling. And they're looking ahead, and they don't want it to cool anymore. They expect the unemployment rate to rise a little bit more, but they want to act preemptively to prevent the labor market from going ahead and getting worse because they think they're basically won the war against inflation. My friend Jason Furman, former Obama advisor, said this is as close to mission accomplished as you're ever going to hear from the Fed.
There has been some suggestion, as you've heard too, that they're making a bigger cut now because they may have been slow to recognize a potential economic slowdown and are now trying to catch up. Do you see any validity to that?
Absolutely. I mean, a lot of people thought they should have begun cutting rates in July. And Fed Chair Powell was asked about that today in the press conference. And he sort of said, well, if I had seen the numbers I saw right after the meeting, maybe we would have. So yes, absolutely. They may be a little bit behind the curve, but they don't want to be very far behind the curve.
So this does now lower federal fund rates to between 4.75 and 5%. What does this mean for everyday Americans, how they're going to feel the cuts when it comes to mortgages and credit cards and auto loans?
So one of the ways that monetary policy works is through financial markets. And financial markets have been anticipating a rate cut. The Fed has signaled it pretty aggressively. So mortgage rates have come down from about 7.2% to 6.2% for a 30-year mortgage. Auto rates have basically begun to come down after going up a lot, not much. Rates on credit cards haven't come down much at all. They went from 17% to 22% on average on a credit card loan, but they will now start to come down. So all the rates that consumers pay will gradually come down as the bond market adjusts to this new Fed posture. Of course, on the other side, people who have savings and money market funds are going to get less interest.
The Fed has been pretty aggressive, or they were rather pretty aggressive in raising rates over the last few years. Does today's more aggressive decision suggest they will be equally aggressive in cutting rates in the months ahead?
I don't think so. The Fed was aggressive in raising rates because they were really surprised by how virulent inflation was. And now they're going to move cautiously. As Jay Powell always says, you don't want to do too much, you don't want to do too little. Plus, it's pretty clear from what people have said, Fed officials have said, and it's some of the predictions that they made when they published today, that not all members of the Federal Open Market Committee are happy with moving this fast. So Jay Powell may be constrained a little by internal politics.
As you well know, the economy is the #1 issue for American voters. We are weeks away from a presidential election. We did hear the Republican nominee today, former President Trump, suggest that the Fed could be playing politics here. How do you look at that issue?
Well, look, this was inevitable. Whatever they did, they're going to be accused of doing something to try and tilt the election. If they'd done too little, the Democrats would have said you're holding back because of the election. I think the bottom line is I actually believe the Fed, that they're doing what they think is necessary for the economy. They're trying to avoid thinking about the timing of the election. People don't believe that, but that's why we have an independent central bank with kind of technocratic leadership so they can do what's right for the economy. They know they're going to get grief from the Republicans, although the Republicans are a little bit ambivalent. Speaker Johnson today said, well, I don't think they should have done it so close to the election, but I'm glad they did it. Not exactly a clear message.
You also well know the inflation rate is not yet at that target of 2%. We know they're working towards. Fed officials say part of the reason behind the move today is they've gained confidence. It is moving sustainably towards that target. Is it basically a downward trajectory here when it comes to those inflation rates, or are there unknowns ahead that mean inflation could tick back up?
There are always unknowns. That's the nature of the economy. But it looks like we're on a steady downward trend. A lot of the supply side issues that made prices go up have abated. The labor market is softening. The level of wage increases is just starting to come down. So I think the Fed is right to be confident. Plus, if they get to a little over 2 and they gradually get to 2% between now and the next 5 years, they'll think this is a victory. 2.0% is a good target, but it's not a magic number. I think they were waiting so they could actually say the first number was a 2, and that would give them the freedom to do what they did today.
David Wessel of the Brookings Institution, thank you for helping explain it to us all. Appreciate you. Good to
You're
see you.
welcome.